Welcome to Shadow of Truth, and your hosts are Dave Kranzler from InvestmentResearchDynamics.com and Rory Hall from thedailycoin.org. And today is Thursday, June the 30th, 2016, and this is a quick silver, and gold, and other markets update. Thank you so much for being here. I'm just glad you're here.
Likewise, so am I. I'm glad you're here too.
So silver staring that line in the sand right in the face this morning. It's right around 8. Silver staring the line in the sand that Craig Hemke and Bill Murphy both have alluded to, the 1850 line, and it's up there sniffing around it this morning. And if it gets up above that and holds, then if you remember last week when we talked to Craig, he was saying that 21-22 is in the cards. Next level up.
I hate to quibble with geometric technical analysis, but actually 1825 was probably technically a more key area.
Really?
And yeah, I mean, it's just simple chart analysis where you're looking to see, silver sold off very quickly from the low 20s to below 18 back in, I guess it was between 2011 and probably 2012. I'd have to look at a graph to see for sure. So it wasn't, and it was probably being heavily shorted. So there's probably a lot of stops, buy stops that are set there to cover shorts that gets above that. So
you think what you're saying, if I'm hearing you right, then the institutional money and their algorithms have been tripped already.
Well, it's possible. Yeah, I think that the bullion banks are on the COMEX, and I meant to look at the open interest before we did this call, but I'll look at it right now because I have it bookmarked. I have a feeling that they are doing everything they can to slow down the rise of silver. I was looking at some numbers. I was actually going to do a blog post about it, and I didn't get a chance to do it. But COMEX has an issue here because when you look at the open interest in the amount of paper silver that's outstanding, it's over a billion ounces of silver in paper silver are open on the COMEX. Well, guess what? The world only produces 800 million ounces a year.
Right.
So, and then if you look at it versus the amount of silver that's being reported to be held on the COMEX, and I believe that's a misrepresentative number. I don't think they're reporting the right numbers. I think the real amount of silver in their vaults is lower. But, and again, these numbers are from the top of my head. I think they have about 150 million total ounces, of which about 23 million are in the registered category. So you're looking at, let's just look at the total versus total paper of over a billion ounces against 150 million ounces of total silver, which means if 15% of the longs over the next year decide to hold, the COMEX operators would have to confiscate all the silver in all the vaults to deliver into it. If nothing else changed.
Oh, wouldn't that be nice?
That's kind of a crude way to look at it, but that's the terms that you can sort of put it in.
You think the owners of that silver might have an issue with that?
I don't think they'll have a choice. Ask the guys who had warehouse receipts for silver bars when MF Global went under. They never got to take delivery of those bars. JP Morgan took them.
No, they didn't. They didn't even get anything except, you had stuff here. Sorry, it's all gone.
They got settled in cash. That's what happened.
And didn't even get 100%.
That's right. So, and it's interesting you do bring up silver because silver's been buoyant. One of the other interesting things I've noticed, and this has been this way for, say, the past, 6 to 9 months, they've managed to associate the hedge fund algorithms with between silver and the direction of the stock market. So in other words, silver is both industrial and monetary. So over the past 6 to 9 months, and I haven't done a scientific measurement of this, but I can guarantee you the correlation's there. That silver seems to be more highly correlated with the directional moves of the S&P and the Dow than it is with gold. So, for instance, earlier this week when the stock market was selling off pretty hard, silver was actually red, right? As were the industrial base metals, and gold was green. And then if you look at, say yesterday, well, silver I think was green yesterday.
Yes, very.
Today's a good example. S&P's up, silver's up a lot, gold's red. And so the only way that I can explain that is they've managed to manipulate the hedge fund algorithms into correlating silver with the directional move of the stock market on the premise that it's primarily an industrial metal, which primarily it's not.
No, not anymore.
Right.
I mean, Louis Camerosano has shown through his analysis that right at 50%, maybe even more, is coming out of the mine and going straight to investment. At least 50% minimum. Big change from just a few years ago.
Absolutely. And we haven't even seen the poor man's gold aspect to silver kick in, because if you have, say, less than 1% of the people in this country actually understanding that they need to own precious metals under their bed, what's going to happen to the demand for silver when that number moves from 1% to, say, 5%? You're going to blow up the silver market because there's not going to be enough silver to take care of that demand, or the price is going to rocket a lot higher. But the thing of it is, silver behaves in the same way that gold does in terms of a currency. I mean, silver is actually really technically more of in the Constitution, it's really more of a monetary metal than gold is.
Yes.
It's more fungible.
Yes.
Right? Because it's smaller denominations. So, and it also, if you're, an average middle-class guy like we are, you probably don't have enough money laying around to go out and buy an ounce of gold once a week, but you do have enough money lying around to buy a couple ounces of silver.
Exactly.
And so that dynamic, the rich guys are accumulating, Soros and Druckenmillers of the world are accumulating gold because it's easier for them to put a lot of wealth into gold than it is to silver. But the middle class guys like us, we're accumulating silver because it's easier for us to buy ounces of silver, and it's more fungible.
And more fungible. That's really the key. I mean, I like the small fractional gold. Has a much higher premium on it, but I still like because of the smaller the 2 peso is one of my favorites. 2 peso gold coin. They haven't made them in a long time, but it's a small national, government minted coin that anybody in the world can recognize it as gold and know and have an idea of the gold content within that coin. I love those little coins for that reason.
Sure. Same thing with the British sovereigns.
Exactly.
I have a couple 1/20th of an ounce Chinese gold pandas.
Yep, got a
but
couple.
I'm not going to spend those if I don't have to because the premium on them. Right. I probably paid about it. I don't remember what the premium was. It's 10 to 12%. I mean, that's why I don't like the gold fractionals. I think they're worth having, and the premiums are going to go up on them because they'll also, the poor man's gold dynamic will kick in, and there will be a lot of demand for fractionals because people won't be able to afford full ounces, so the premiums are going to go up.
That's right. That is exactly.
And I'm talking about, this is just if all of a sudden, instead of less than 1% of the population of this country understands why they need to own gold and silver, it moves to just 5%.
Well, this is
you're not moving the needle very much there. What happens if all of a sudden it's 10%?
What Lewis did, and it was very cool and it was very clever, is he took the U.S. workforce as reported by the Census Bureau. And he took that number, and then, so you've got a number of people, and then you've got the number of investment dollars weighted against that. And he broke it down by, each one of these investors that are in a 401k or an IRA, and added 1 ounce of silver to their allotment, to their investment. And then he added 2 ounces and 3 ounces. And the needle just started going exponential. And that's from regular retail investors. And he used a percentage, just like what you're talking about, Dave, 1%, 2%, 3% of these investors. And it is ridiculous at each increment how things just explode. And there's no way they would be able to, there's no way that the market could handle the change. No way. Physically impossible.
Well, it would handle the change by the price going parabolic. That's how it would handle it.
Parabolic. That's exactly what would have to happen.
See, here's the problem. They've artificially held down the price of gold and silver for so long, and there's been an inordinate amount that has been accumulated relative to the price. So they've a lot of the gold and silver supply that's available to be accumulated has been removed from the market at this artificially low price. So then you're going to have a snapback effect when all of a sudden a lot of people want to have it and the price starts to go up. The price is going to have to correct upwards by a lot in order to balance out the supply and demand. And that's what's going to happen. And you're also going to see premiums on these things like Silver Eagles. We'll see premiums go to 100%, if not more. And see, it's going to play out like this. I mean, we saw Draghi's speech the other day, and the Japanese Bank of Japan guy, I think it was him or the prime minister, gave a speech, basically said the same thing. We're basically going to start entering an era of hyperinflation of currencies, and these guys aren't going to have a choice because the central banks have backed themselves into a corner where it's either print money or the system collapses. That's where we are right now. I mean, the only way that they're keeping the markets up right now is extreme intervention. I mean, it's this bounce we've had in the S&P has been extraordinarily low volume, and it's primarily the stocks that are the most heavily shorted are the ones that are going up the most. So it's basically an engineered short squeeze to keep the indices up higher. But underneath, there's plenty of stocks and sectors that are crashing still. And look at the banks today. I mean, earlier Deutsche Bank was down almost 5%.
Good.
And that, to me, that right there is an indication that the banking system, the financial system, is in real trouble.
Good.
I mean, all of the too big to fail banks. Well, J.P. Morgan's green now, but it was red earlier. All of the too big to fail banks are red today, and not many people noticed it. But yesterday, when the stock market was squeezing higher, especially toward the end of the day, Deutsche Bank was down on the day, and that's a message that the market's sending. It's telling us that the financial system is in very, very bad shape and probably on the brink of collapse.
And it's not isolated to Deutsche Bank and Germany. It's not isolated to J.P. Morgan and Wall Street. It's not isolated to RBS and City of London. They're all connected. So if one goes, then wouldn't they all go?
Absolutely. They're all interconnected by the derivatives. I mean, that was the thing about all the quote unquote financial reforms that they put into place after 2008. The Dodd-Frank bill and the Consumer Finance Protection Bureau, that was Elizabeth Warren's redheaded stepchild. I mean, it was all a bunch of BS. All it was lipstick put over the pig that told the public, come on back in, the water's warm. Well, all that legislation did was make it easier for the banks to hide their fraud. And so what you have now, by every financial measure, debt, quality of debt, amount of derivatives, everything is worse now. Every nuclear bomb that went off and blew up the financial system in 2008 is even worse now. and the central banks are out of ammo to address it, other than just outright money printing and helicopter dropping of that money. Interest rates are at zero. They've already printed trillions. So, I mean, they've pushed the system with their manipulation and intervention to an edge. It's on the cliff. And the only way to hold it up now is to hyperinflate the currencies. And that's when we're really going to have some fun with the precious metals.
Let me ask you this, Dave. Back in 2008, as far as what you were just saying and all this nightmare, all this goo that they have created since then, in 2008, did we have $11 trillion in negative interest rate bonds? I don't think
no,
there
not
was.
Even close. I don't think we had any.
We didn't have any. That's
No.
right. So now
not even Japan.
Not even Japan. So now you take all of the nightmare that's not even been addressed, it's not been looked at, all the fraud, all of everything that has been happening, that happened in 2008 and has happened since, and now you throw $11 trillion of negative interest rate bonds on top of that. I'm not a mathematician. I'm not even really that smart, but I'm not that stupid. I mean, I can see that this is a gargantuan problem that cannot be addressed in any manner that makes sense at all.
No, and it's interesting because even the smallest little financial bombs will set it off. I mean, quietly, and it was not mentioned in the mainstream media this week at all, but Congress, both houses of Congress, passed legislation to bail out Puerto Rico. And Puerto Rico is about a $70 billion debt problem, and it would blow up a couple of the mutual funds in this country if Puerto Rico defaults on its debt. But no, guess what? The taxpayers in this country are going to bail out Puerto Rico. But if they're so desperate that they have to bail out a $71 billion problem, what's going to happen when the Italian banks start collapsing and the Spanish banks start collapsing? Deutsche Bank's going to start collapsing. We have banks in this country that are on the brink.
They're all zombies. I mean,
you're talking about
for a long time.
Right. Some of these banks have, most of the too big to fails have multi-trillion-dollar balance sheets. You compare that to Puerto Rico. Puerto Rico's a small issue, but they're not willing to let Puerto Rico go under and restructure and reform its finances. They'd rather just throw money at it because it's our money. It's not theirs.
Right. Well, I think the next month or so is going to be very interesting. I hope we make it through the next month or so. I mean, it kind of sounds like, Dave, that everything is kind of coming to a head. I mean, it seems like gold and silver, as you and I talked about over the past couple of weeks, that they've been sniffing out something really bad, and now that sniff has turned into a vacuum, and it's getting closer. It seems to be moving closer to the source of whatever it's been sniffing around. And or am I wrong in that? I mean, it seems like that they're both just kind of like, there's something foul over there, and they're moving in that direction.
No, you're absolutely right. I mean, they're having it's right now they can't push the metals lower. I mean, they've been throwing. You've had silver. The open interest in silver hit a record. I think it was last week or maybe early this week. Which tells you they've been throwing an inordinate amount of paper at the market in order to contain the price. And the gold open interest also went over 600,000 contracts. And that's where it was at the peak in 2011. It's over 600,000 contracts. So we're at a much lower price level, and yet you got the same amount of paper out there. So it tells you that the volume of paper they're throwing at this market to try and use the COMEX as a mechanism to keep the price down, and they can't do it. All they can do is they're in a sort of a managed retreat mode, which means they're just trying to put a damper on the rate of increase in the price. Because it's okay if it goes up slowly, no one notices, right? It's the boiled frog syndrome. But all of a sudden, if you had a week where gold goes up a couple $100 and silver goes up $2 or $3, that's going to get a lot of people's attention, and that's what they're trying to deflect. So all these other things going on around the world, these airport terrorist events, or the Brexit, or the conflict between Trump and Clinton. That's just all that is managed distractions to get people distracted away from what's really going on.
And what's really going on is the absolute and total collapse of the entire global economic and financial systems.
That's right.
Well, folks, all I can say is pull your boots up tight and hold on, because it looks like it's going to be a hot summer.
It's already been hot here. We've had a couple of days over 100.
Oh, my goodness.
I know.
Well,
only June. I mean, we get a couple of days like that in July, but
goodness gracious. Well, Dave, hopefully the rubber bands, chewing gum, and Band-Aids will hold together till Monday. Well, Monday is the 4th, so happy 4th,
Tuesday.
Everybody.
Yeah, I hope everyone has a nice long 4th of July weekend.
Yeah, hopefully you'll just be blowing up fireworks instead of banks.
Turn off your computers except for checking my blog and Rory's blog, and enjoy your weekend. Try and forget about all this other nonsense going on around the world.
Yeah, what Dave said. You want to try for Tuesday, Dave? You want to try to pick it up on Tuesday, and we'll just see what's going on from there?
Yeah, let's do that.
All right, buddy. Have a good weekend. Have a good 4th, and we'll talk to you then.
Sounds good. You too.